Today, we will talk about the federal discount rate, definition, versus federal funds rate. The discount rate is the interest rate set by the Federal Reserve on loans extended by the central bank to commercial banks or other depository institutions. It allows the Fed to reduce liquidity problems and control the supply of money in the economy. The federal funds rate, on the other hand, is the target interest rate for overnight interbank lending, where commercial banks borrow and lend excess reserves between each other. The actual Fed funds rate is determined by the market supply and demand for overnight loans, and is generally lower than the discount rate. The Fed can lend directly to member banks and depository institutions, acting as a lender of last resort to ensure the stability of the banks and the financial system. Banks that are unable to borrow in the interbank market can turn to the Fed for emergency loans. Under normal circumstances, banks prefer to borrow from one another, and the discount rate is intended to be used as a last resort measure. The discount lending is generally classified as either primary or secondary credit, with the Fed also setting a seasonal discount rate for non-emergency lending. Depository institutions and commercial banks that are in sound financial condition are eligible to borrow at a primary credit rate, while secondary credit is given to banks that are in financial trouble and experiencing severe liquidity problems. The federal discount rate is used as a tool to stimulate or rein in the economy. A decrease in the discount rate makes it cheaper for commercial banks to borrow money, increasing available credit and lending activity throughout the economy, while a raised discount rate makes it more expensive for banks to borrow and diminishes the money supply. The Fed also has several other monetary policy mechanisms, including open market operations and reserve requirements, to influence the money supply, credit, and interest rates. The federal discount rate is the interest rate the Fed charges on loans, set by the Fed's Board of Governors. It is higher than the federal funds rate target, which is set by the market between member banks. The discount rate is intended to serve as a backup source of liquidity for banks, while the Fed funds rate target is considered more important in terms of its overall impact on the economy. Here are 4 key takeaways. 1. The federal discount rate is the interest rate the Federal Reserve, Fed, charges banks to borrow funds from a Federal Reserve bank from the discount window. 2. The Fed's discount rate is set by the Fed's Board of Governors, and can be adjusted up or down as a tool of monetary policy. 3. Lending at the discount rate is part of the Fed's function as a lender of last resort, and is one of the Fed's primary monetary policy tools. 4. The federal funds rate target is set by the Fed, but the actual rate is determined by the supply and demand for overnight loans in the interbank money market. Hope this would help. Thanks for watching.